Good afternoon. This is Jay Pocklington, working for the Young Scholars Initiative and INET here in New York. Unfortunately, we had some trouble connecting with you earlier, and therefore we decided to have Rob continue his speech briefly here via video, and I hope you can access it at a later point, maybe during your evening or so forth. So Rob, please.
Sure. So let me be brief because we got about 8 or 10 minutes. With regard to education and finance, I think the very first thing you have to consider is that the mathematical models of finance assume a terminal equilibrium. At some point in the distant future, the system is anchored. I think that assumption is tantamount to garbage. It is absolutely unfounded, and most great investors, whether it be Warren Buffett, Soros, Seth Klarman, talk about the difficulty is there is non-routine change. Whether you're buying a stock and trying to understand earnings flows or a foreign currency or what have you, there is just no chance of predicting the distant future, which changes the entire nature of the environment relative to these equilibrium models. And they're an interesting thought experiment, but pretty soon I would put them aside. I would study questions of subjective psychology, and I'm not talking just about simple behavioral economics. I would look at, say, for instance, Roman Friedman's book, Beyond Mechanical Markets, and I would study a great deal of financial history. The scope of the possible, the things that you can learn about in your imagination, really derive from past experience. Always there's new innovations on the horizon. But if you read a book like Charlie Kindleberger's Financial History of Western Europe, or the shorter version, Manias, Panics, Crashes, you have a very different vision of financial markets than exists in the academic literature today. Having said that, when people read something like Efficient Market Hypothesis or Burton Malkiel's book, A Random Walk Down Wall Street, I actually think this is a good warning. When my mother was buying stocks in Detroit, Michigan, if she would read something in the Wall Street Journal and say, oh, that's an interesting story about Finland, maybe I ought to buy the stock, the second thing she's got to think about is, when did people in Finland know that information? And perhaps what she's seeing in the paper is something that investors priced in, 3 or 4 weeks ago. So the question of information as a stimulant is always in relation to what it is that's been introduced into prices as information before. In this sense, an efficient market is a cautionary warning that if you're going to have an edge, if you're going to make money with information, you got to know that you have information that others don't have, and you also have to know when they're going to learn it so that it becomes something that actuates their investment behavior and moves prices in a direction towards what you believe the truth to be. But I would start with a very big dose of economic and financial history. In other words, look at what the world has produced and then seek to explain it. Don't come up with these whitewashed, simplistic models and act like, oh, therefore that's how the world works because all the rigorous academics say so. In my experience, modeling technique has dominated what you might call vigilant observation of the world, and a young financier, an aspiring financier, has to shake themselves loose from these frameworks which have produced what you might call excessive confidence in the control and precision of their models, which is unjustified. In 2008, we learned a lot about that. Second thing I would say is people play games with statistics. We've got all kinds of software and spreadsheets now that we can use that lets you estimate things and come up with coefficients. And then you act like you're being a scientist because you think somehow those coefficients are somehow structural, like they would be in an experiment in chemistry or in physics or in biology. But the regularity of subjective expectations in financial markets, it does not lend itself to believing that many of these things are structural, or at least the parameters are stable. Coincidentally, they may be for a while, but they are until they aren't. I was at a dinner last night with a whole bunch of people who were veterans from Wall Street who talked about the Russian debt crisis. And as you know, the famous episode of the firm long-term capital management going bust, because a whole bunch of Nobel Prize winners and everybody else thought these correlations that they derived statistically were somehow, which you might call etched in stone, as opposed to essentially mirages. So you can do the statistics. The question is whether you believe the statistics are the basis upon which to make decisions. And just in simple English language, past is not always prologue. And the stability of parameters estimated on yesterday's data may or may not be an adequate guide to today or tomorrow's unfolding events and therefore asset prices. Moving on from the academic questions and how to prepare yourself, I think that, as I mentioned before we were cut off, I believe it's going to be much more difficult to make money in the next 30 years than it was in the last 30 years. I think making money is a good thing. It allows you to pay off your student debt. It allows you to take care of your family. These are all noble things to work for. But at a longer term and a deeper level, there is a crisis in finance right now over the question of what it is that you're doing that is socially productive. And buzzwords like price discovery or providing liquidity just don't cut it. And they don't cut it inside your own heart when you reflect on these things for a while. I spent a lot of years in the financial sector. So thinking, and there are very important elements in which finance plays a very positive role. But we're coming from an era, as Andy Haldane wrote about in his book, Banking on the State, where the social contract between society and the financial sector is leaving society somewhat enraged. A lot of very smart and ethical financiers that I know are quite demoralized right now. And I'm working with the World Economic Forum on a group called The Role of Finance in the Future of Society. What I'm getting at is the future of society depends upon finance playing a constructive role, and we are coming out of a period of excess where the rules need to be redesigned, and quite honestly, it's not likely to be as lucrative for finance. Finance did a very good job of seeking options, meaning upside was theirs, downside was laid off on society. I don't think in the medium term, even though the financial sector is politically quite powerful, that we will see society tolerate that. The pendulum of that social contract that Haldane talks about will be rebalanced and once again make it harder to make money in finance. But I think the other dimension, and I can cite George Soros in this regard, is what you do with the money you make in terms of your social purpose downstream is important to integrate with that you made the money and how you made the money and taking the measure of one's career. So I think you can have a lot of fun in finance, you can learn a lot, there are a lot of smart people, you can travel the world, but I would hope that, how would I say, in your own explorations that you seek a deeper purpose and a sense of how you're contributing to family, to community, and to generating your own personal freedom so you can do interesting things in other dimensions of your life. But you probably will face a good deal of controversy with people questioning whether you're doing things that are valuable socially in light of the acrimony following the 2008 catastrophe. So I'm sorry I couldn't be with you more live today. Telecommunications didn't quite support us. And I wish you well with your conference and your meeting. And please email me at INETeconomics.org or talk to Jay. And if any of you have personal questions about your career or things that you'd like to explore, I'd be happy to enter into a conversation with you. Good luck.
Thanks, Rob. See you all later. Bye-bye.